Will today's risk-off action continue into next week, and what could it mean for the broader market? I don't know, Tim, how you decipher this. There's an appetite for risk on one hand, but there's not an appetite for risk when you take a look at the other trades.
Well, it feels a little bit like the barbell trade that I think makes a lot of sense overall anyway. There's a place for some growth and maybe a decent part of aggressive growth, but then some value. And I look at healthcare, and I look at a place where whatever healthcare proxy you're looking to invest, whether it's one of the ETFs or whether it's actually investing in a handful of the core names that have been really looking to base for a couple of years, I think there's an argument for both sides of the trade. Remember, where were we a week ago? What a difference a week makes. I mean, we went last Friday into a weekend where even as we got into late on Sunday at some point where futures were also indicating we were going to be looking at a combined kind of 2-day down 4 or 5% move. And suddenly we've now had the best week since August after having the worst week since August. So I think the White House has helped calm fears about a fresh, it's not fresh, is it? I guess it's China and where are we? And the rhetoric was very conciliatory or very comfortable that we're going to be in a place. The regional bank concerns, which I know were just discussed, I think are something that the market is focused on. But again, I think of this as a week when banks gave you full steam ahead in terms of a trade where I actually think the regional banks are possibly more interesting than the money center banks at this point. So, again, sprinkling a week that it's all relative to where we started. We're also getting data in terms of cash on the sidelines coming into this market. We talked about that. There's a lot of money on the sidelines. As rates come down, more cash comes into the market, or at least that was the trade this week.
Yeah, it's interesting to see where the gains were made in the markets this week. I mean, semiconductors were up almost 6% on the week. At the same time, the equal weight S&P 500 notching almost similar gains, neck-to-neck gains with the S&P 500 market cap weight. So it's sort of it's a weird trade going on, I think.
There's a whole lot of weird going on. I mean, I don't know what the differential was between very early this morning where the futures were and where we ended up. A lot's happened, and yet I don't know that anything has really happened, but feels like it. I like going into earnings season where we have something very tangible to sort of, shoot against. So I like that more than whatever the headlines may be, and they may change every day or within a day. So I do like the idea that maybe things are calmer on the U.S.-China trade front, but I agree with Tim on the banks. I thought banks were solid, which is great, not just for the banks, but banks are really, that's a good look at the economy. And so that seemed like the economy was in pretty good shape. So I like the banks and agree with the regional. I think that this is not the sort of systemic threat that the Silicon Valley Bank situation was in any way. So I think that's sort of an interesting place. We had a few banks today, had regionals that had good earnings, solid. Truist Financial, a bunch of others.
Yeah, I agree in terms of what's been reported. It has been relatively strong, and I think that's reassured the market. I think we have to remind ourselves that there is a bit of a data blackout, so you should expect some additional volatility because people are essentially trying to attach some ability to garner information from every incremental piece of data, and that's going to be scrutinized a little bit more, being that we just don't have the same steady flow of information to kind of hang our hats on. As far as the banking crisis is concerned, I agree. There's nothing yet to suggest that there is a contagion, but I can understand that investors remember 2023 and are likely looking for some indication that perhaps this is not just a self-contained situation. We have kind of spoken ad nauseum about how the proliferation of private credit and buy now, pay later, all these other things that are a little bit more difficult to monitor. So while I don't disagree with everybody else in terms of what we have had so far leads us to believe that there is expansion. We've seen equal weighted kind of perform well. So you are seeing that broadening of the market. But given where we are, and if you look at valuations, and particularly if you look at the AI-related valuations up in the 90th or 95th percentile, I think it is to be expected that people want to be the first out of the door. What is it, FIFO, if you will, as opposed to being kind of like held and forced to kind of hold that drawdown. And so while I do want to point to the market performance, I do think Bitcoin and gold, and then when you couple that in with the volatility that we have seen in the 10-year Treasury, it does kind of lead people to be a little bit more on edge. And given where we are with performance, I can understand.